This week has seen massive volatility in the precious metals space, with gold prices falling over 5% in one day. That's the biggest one-day decline since 2013. So over a decade ago, we saw this kind of volatility. Now, what does this mean? What's driving it? Where do we go from here? Of course, it has seemingly been a very much a one-way trade recently. So everyone's really trying to gauge whether this is the beginning of a top and a major market sell-off or a buying opportunity. So I'll try and pick the bones through the data and try to look through the likes of gold and silver to see where we could potentially go from here. So there's a few slides that I've prepared for previous videos that I created on gold that I think will be pretty useful to be able to look at here. First and foremost, this is a sort of overview of the components of gold demand over recent years. And crucially, what I think is noticeable here is that we've seen a drop off in terms of demand from the jewelry space and a widening in terms of the investment space. And I think that's important. So an increased role played by those speculating on price and investing in gold rather than simply buying jewelry. Now, if we look in terms of ETF purchases, you can see where much of that speculation comes from. You can see much of it attributed to North America. Then you see Europe and Asia. Now, why is this important? Because arguably, if you see people buying jewelry, they're not necessarily going to be doing so because of movements in the price, and therefore you're likely to see more stable market environments. If you see massive inflows and outflows in terms of investments, then you're seeing greater speculation. Greater speculation tends to bring greater volatility. This is the gold volatility index. In actual fact, this was prior to the breakdown that we saw in terms of price yesterday. So this would have moved up, but this had already signaled a significant surge in terms of volatility, with expected volatility certainly on the rise. And that expected volatility came because of the fact that we'd seen prices run up so heavily. There's a perception that, of course, overextension points towards a possibility of a snapback. It's exactly what we're seeing at the moment, and people don't necessarily know what has caused it. Is this a bout of profit taking? Is this a case of something going too far, too fast, and therefore we need to see some sort of normalization? Is this an end to the trend, essentially, and we've topped out in this market? It's difficult to say, but certainly I'm going to try to go through some of the charts and try to show you exactly how I'm seeing it at the moment. But certainly what constitutes the demand picture for gold has shifted recently, and that favors greater volatility, which is exactly what we're seeing, the biggest one-day decline since 2013. Now, another side of demand comes from central banks, and we can see that in terms of the previous slide that we have here with the red section alluding to central bank buying. You can see that we're seeing a shift towards gold as a sort of treasury asset, essentially, and more away from some of the other currencies, most notably the US dollar. Of course, that feeds into the narrative around the whole Trump thing. He's come in, he's broken down relations with different countries. You've got the BRICS nations pushing back against the US, as he essentially breaks relations with countries around the world. So people want to move into assets like gold. They don't necessarily want to be part of the dollar space at a time when many countries are essentially trying to de-dollarize and move away from a system that is reliant on the US dollar. Instead, you are seeing many central banks really buying up the likes of gold and moving towards gold as a asset. So that means that there is a perceived volatility element coming into play whenever you see big ticket news around trade deals, the breakdown or the potential resolution of trade spats. And of course, US-China comes into that this week. We've also got the US-Russia talks that were planned, but they've actually been called off now. But notably, if we're talking about central bank buying as being a potential source of this volatility, it's unlikely, because in actual fact that it's been playing a lessened role as time goes on. And you can see that here with the breakdown in terms of monthly central bank activity shrinking over the course of the past year. So we're not necessarily seeing the same kind of degree to which the central bank purchases are happening. Some of it is unreported, so it might not show up here. That is worthwhile noting, and it might fall within the investment side of things. But I do think the investment side is probably more notable. And then when we're talking about the whole central bank buying and that as a pushback against the US, in actual fact, if you look at year-to-date central bank purchases, you can see at the top of the pack it's the likes of Poland, Azerbaijan, Kazakhstan. They are aligned with Russia more so. Then you have the likes of China, Turkey, kind of sit on the fence between whether where they're aligned to, but then Cambodia, Ghana, Qatar, India. But I would say that many of these countries, from a central bank perspective, aren't necessarily just BRICS nations, which we have seen a huge amount of BRICS buying over recent years. But that's not necessarily the only thing really driving the central bank purchases of late, and in which case you know, when you're saying that the shift in terms of sentiment around, say, talks between China and the US is going to essentially push the Chinese away from buying US treasuries, and instead they're going to be buying gold. And therefore, if we see a resolution between the two sides, it means that the Chinese are actually going to buy US treasuries instead of gold. So that demand dries up. Well, look, ultimately, the Chinese are fourth in line here behind a number of other countries that aren't necessarily going to be moved by whether there's a trade deal between the US and China or not. But certainly markets will be moved by that because there's a perception around risk within markets and therefore demand for havens. So if there's a breakdown in relations between the two world's largest economies, well, that means maybe head for the havens, and that's where gold comes into play. The flip side of it is if you see a resolution or the possibility of a deal, people suddenly start to move away from gold because they don't necessarily think that that haven is required to the same degree. So again, it really comes into that investment side of the demand picture. Now, alongside these, you have the perception around interest rates from the central banks. So if we were to perceive interest rate cuts as being around the corner, if we think we're going to see more dovish outlook from the Fed, if we think we're going to see QE, those kind of things generally tally up with strength for the likes of gold, in part because of the dollar devaluation story or the fiat devaluation story. The more rate cuts we see around the world, the more people think that they should be moving into gold. But I've overlaid the US 2-year yield, which generally tracks well with sentiment around what the Federal Reserve is going to be doing. I've inverted it here, but you can see here this correlation between the two. But notably, as we see this market collapse, we haven't necessarily seen that move in terms of the 2-year. So it would essentially mean that we're not necessarily seeing something that is tied up with a shift in perception around the pace of easing for the US at the moment, in my mind. So, you know, oil prices still relatively low. Yes, we have 2 rate cuts ahead in the back end of this year that markets are expecting. We have got question marks around inflation data at the back end of this week. But, you know, I think at the moment, markets are quite confident that we are going to see rate cuts ahead. January, likely to see a rate cut according to markets. And then by the midpoint of 2026, Trump's going to have his man at the helm of the Federal Reserve, and in which case that points towards a more dovish outlook for the Fed at the back end of next year as well. So I don't necessarily think this comes down to rate cuts. Now, one of the things in my mind that is likely to continue propping up gold for the long term is the perception of fiscal instability, the growth in terms of debt, and the instability of the balance sheet of many of the central bank, many of the governments around the world and the treasuries around the world. That, in my mind, is not going anywhere. Now, certainly the US is helping things by bringing in all this tariff revenue, but nonetheless, the debt pile continues to build. And since this huge amount of debt has been taken on since the pandemic, that sheer size of the debt is just very unlikely to decline in any meaningful way. Instead, that's just going to snowball and snowball. And that gives good reason for people to be fearful or at least apprehensive about getting into fiat assets, instead favoring things like gold. And I think that narrative is not going to go away. So that, for me, gives me the perception that this is going to be a long-standing bull run and it's probably not come to an end. However, of course, we do have the fact that prices have just dropped so sharply. So this is the gold monthly time frame, and this sort of gives you the wider context to it, right? We've been on an incredible run. We've seen prices rise throughout much of the back end of 2023, but the entirety of 2024, and then pretty much everything up until now in 2025. Now, you do see periods like this, right, where you see that strong run up, where you see a bunch of big monthly gains, and then you see a fade at the back end of the month, and then consolidation before we punch higher. And this is something, it feels like it wasn't that long ago, that we were talking about, because we were in the midst of this, and we were talking about this as a sort of symmetrical triangle formation, waiting for that breakout, which eventually came, and we really followed through in a meaningful manner. So this is sort of where we were at the time. Here we go. So we've got this symmetrical triangle. We saw the breakout, and we really followed through in a very aggressive manner as a result. But markets can't trend in a straight line forevermore. And so at some point, you're probably going to see profit taking coming into play, which is what we're seeing at the moment. The increased role of investors and speculators, meaning that we're seeing that volatility coming into play. And so with many of the sort of trade deals now seemingly agreed, of course, we have got the US-China issue, but then also the possibility of some of these wars sort of having a line drawn under them near enough. You know, do people think that this is the time for another breather phase? Like I said, the underlying story and narrative around debt, I think, is going to continue to push gold up over the years to come. But markets do not move in straight lines. And the question mark here is, do we move into a wider retracement here and move into something like this, a consolidation phase? Is this just a short-term pullback before we pop straight higher and reach record highs once again? I'm more inclined to think that we're now entering somewhat of a consolidation phase for the near term. I mean, look, if you're looking at the, say, 4-hour chart, you can see we've dropped back below trendline support. We've broken through the 76.4 fib level. We posted a sort of tentative rebound here, but ultimately we've dropped once again. If we were to rally back up through this near-term high that we've just posted, and we do so before breaking the sort of 4,000 mark, then yes, you could say, okay, we've created a higher low, we've created a higher high, maybe we're starting to bottom out, and this is where all the consolidation and the retracement takes place. However, given the fact we've dropped through trendline support, through that 76.4 fib level, it does raise concerns that we could be in for a wider retracement phase to come into play. And in which case, you know, if we were to try and gauge exactly where that's going to come into, it's quite difficult, because it's quite obvious where your first swing high comes into play on this sort of 4-hour chart, right? We've got that double top formation. The 4-hour swing low that we've got here is at 39.43. Below that, are you going to tag any of these? Probably not. So it's quite difficult to ascertain exactly where the swing high of choice is on that occasion. So keep an eye out for whether we break through this swing low that we have around, excuse me, let's just get rid of these lines, accidentally drawn, around this low here of 39.43. A break below that level does signal a wider pullback coming into play, and a possibility that we come into this wider phase of consolidation. If we're looking in terms of the gold to silver ratio, I think this is really interesting. Look at this monthly time frame. We've got this long-term ascending trend line coming into play. It tapped it absolutely perfectly and moving sharply higher. Now, notably, that means the possibility of outperformance for gold against silver. But remember, gold outperforms silver both at the beginning of bull runs, but also at periods of downside for the two, because generally silver is the more volatile of the two. Silver often gets going later on in the bull run when everyone's super confident and they want additional exposure to something a bit riskier. And that's when silver comes into play. But at the moment, we're seeing the possibility of a kickback with underperformance for silver. And we can see that here, that sharp decline that we're seeing for silver at the moment. That's the weekly time frame. We have got the possibility of a move back in towards this trendline support, which is something like sort of 4, 6, 7, 8, that kind of thing. Of course, it's a dynamic line, so it's going to be moving as we go along. If we look from a sort of historical context, you can see here, you know, is this a big blow off before we see a sharp reversal from here? I'm not necessarily completely sold on that idea. I think more likely it's the case that we've just run so fast, so quickly, and now we're coming into a retracement phase. Therefore, I think just follow this on the sort of intraday basis. Sometimes just breaking it down in terms of the short-term trends can be very useful. We've seen this sell-off, the sort of rising wedge formation, the decline from there. We've rallied. If we break back below this swing low of 4750, then it points towards a continuation of this breakdown. Keep an eye out for that ascending trend line. But certainly at the moment, it's the investors and the speculators that are really dominating. The volatility that we're seeing within gold is, in my part, related to that, and I think we're likely to see more of it. But certainly the sort of blow off top that we've seen at the moment does point towards a possibility of further downside over the near term. Certainly if we break through this 3943 on gold, it points towards a wider retracement coming into play. But there's a good chance that what we're looking at the moment is the beginning of maybe a phase like this, where the period where everyone's super confident that gold is just going to go up and up and up maybe turns into a phase where people are saying, well, we could get a trade deal between the US and China. So obviously if that breaks down, then you see the possibility of gold pushing higher. But as we see sort of wars resolved, as you see some of the sort of fears cooling, then you see the likes of gold sort of losing that momentum a little bit. I don't necessarily think the story's over yet, though. I think for the long term, I'm still bullish for gold. I think the massive ramp up in terms of debt around the world is only going to go in one direction. The need to sell that debt also means that you're either going to see high yields or you're going to see purchases from central banks. Therefore, are we going to see QE? There you see the devaluation of the currency. So people don't necessarily believe in the fiat system. I think gold is here to stay as a long-term bullish market, but that rally that we saw recently isn't sustainable. You can't just see it go up and up and up. At some point, you see it sort of taking some of the steam out of the system. That's exactly what we're doing at the moment. And certainly if we break through the 3943, then maybe we do see a wider pullback. But I do think we're now entering a phase that is possibly just a case of some consolidation before we see the bulls start to move higher once again.